Hi all, welcome to the CA classroom. Today let's discuss the topic redemption of debentures. First let us understand what is a debenture. Debenture is a borrowing which company does. Company borrows money from people and they are called debenture holders. They are called debenture holders. Instead of borrowing money from bank, company will issue a security called as a debenture to the debenture holder who will pay money to the company. Company might issue 1 lakh debentures worth 100 per debentures, so the total will be 1 crore. 1 crore money is raised by company, 1 lakh different people can pay 100 each, or if you want to buy more debentures, you can buy more debentures and help the company in borrowing. This is the basic concept. Most of us already know what is a debenture. However, debentures have to be repaid. So it's a borrowing. Term can be 10 years, or based on the nature of issue, they will have different terms and you have to repay it after that. So debenture holder, what is the benefit for him? Every year, just like a normal loan, company will pay interest to the debenture holder and after 10 years, his principal will be repaid. Why will he prefer debentures over a bank FD? Now, even in a bank FD, every year he will get interest which gets accumulated. End of 5 or 10 years, he gets his money. Bank FD, the return is around 7 to 8% on an average. But debentures, the return can be somewhere between 10 to 20% based on the risk. It can be higher also. No. Therefore, higher risk, higher return. Company can also list these securities, these debentures, in the stock exchange. So just like how you buy and sell shares in the stock exchange, BSE or NSE, you can also buy and sell debentures in the market. Now, what we are going to see here is, we will not be accounting for issue of debentures that was done in your school or college. Now, we will mainly be focusing on redemption. How will the company repay the money to the debenture holder? There are 4 ways of doing it. First, lump sum redemption, meaning let's say debentures are issued for 10 years. After 10 years, the entire money principal will be repaid to the debenture holders in one shot. Normally, debentures might be 10% debenture account having some balance. That account will be closed and money will be paid to the debenture holder. What entry will you pass? 10% debenture account debit. I am closing the account, creating a liability. Whom am I making the payment to? Debenture holders. So, two debenture holders. And when I make the payment to them, debenture holders account will be debited and I will credit my bank account. So simple 2 entries. First, creating a liability towards my debenture holders. Second, settling the liability. This is lump sum payment. Second, payment in installments. What happens? Instead of paying entire amount in one shot, they will say after end of 10 years, between the 11th year to the 15th year, every year 20% of the amount outstanding will be paid. So, instead of one time lump sum payment, let us say debenture amount is 1 crore, instead of paying 1 crore in one shot, they will be paying 20 lakhs every year for a period of 5 years. So the same set of entries I will pass for 5 years, but amount will be instead of 1 crore, 20 lakhs each year. Next, before we come to open market, let us see conversion to shares. What do you mean by conversion to shares? The debentures will be converted to equity share capital. So entry will be 10% debentures to debenture holders. Instead of debenture holders to bank, I am not paying my debenture holder, I am giving him equity shares. So to equity share capital, debenture is now converted to an equity share capital. What do you mean by purchase in open market? These are debentures which are listed in the market. Company, what they will do is, they will purchase their own debentures. They will purchase their own debentures. In detail about this, we will see in few sections. Now, let us understand overview of this. Now, irrespective of method of redemption, section 71 of the Companies Act says every company issuing debentures should create a reserve called debenture redemption reserve. Now let us understand what is this reserve and how it works. In the previous section, we have understood the overview of what is redemption of debentures. Now let us understand the concept of debenture redemption reserve. Now, first, very important. What the concept says is, let's say company is going to redeem the debentures after 10 years. Companies Act is saying, every year we want you to save some money, keep it in a separate investment and use that investment in the future for redemption. So what they are saying, every year out of your profit and loss account, trading in P&L account, debit your P&L account for a certain expense. And this amount, this debit, I am not paying anybody now. So I will transfer this to a reserve. I will transfer this to a reserve. So just like how you transfer profit to general reserve, a part of the profit is being transferred to a reserve. That reserve is called debenture redemption reserve. So let's say 100 rupees is debited to my P&L account and transferred to my reserve. What entry I will pass? Profit and loss account debit to debenture redemption reserve account 100. This is the first step I have to do every year, transferring a part of my profits to a separate reserve. Why am I transferring to a separate reserve? Companies Act says you have to save money every year in order to be able to repay after 10 years. Now I am only saving profit. Corresponding to this reserve, in my balance sheet, asset side, what I will have? Cash or bank balance. They are saying, if you keep it in form of cash and bank, without your knowledge, over 10 years, you will spend it. So, I don't want to keep this money in cash and bank. I want to make some investment. Section 71 says, what all places where you can invest. So, I have to make an investment. So, what is entry for investment? Investment account. Debit. How much? I am investing 100 rupees. 100 to cash or bank. To cash or bank, 100. No. For what is this investment made? For the purpose of debenture redemption. So this account is called debenture redemption reserve investment account. So basically, against my DRR, debenture redemption reserve, I will always have an asset which is cash or bank. In balance sheet, for every liability there is an asset. So for every reserve and surplus, there will be a corresponding reserve asset. For every reserve and surplus, there will be a corresponding asset. Hence, for DRR, corresponding asset was cash and bank. I am cancelling cash and bank and replacing it with debenture redemption reserve investment account. Basically, it is an investment made in a government bond or a government trust. We call it DRR investment account. Why am I investing here? Because to redeem my debentures after 10 years. Next, what happens? Every year I receive interest. If you invest in bank FD, you will receive interest. So on this investment, every year you will receive an interest. When you receive interest every year, you will debit bank account and credit your interest account. Correct. This interest is received on what? My investment. So the account will be now called interest on what? DRR investment account. So every year, let's say I am receiving interest of 10, my bank balance will increase by 10 and my interest on DRR investment account will also increase by 10. Normally, interest is transferred to my profit and loss account. But however, interest is earned on an investment which is made out of a reserve. Therefore, income from this investment will also be transferred to my reserve. So the entry will be interest on DRR investment account, debit 10, credit. Normally we credit P&L. Instead of crediting P&L, I will credit my debenture redemption reserve. So every year three things happen. First, transfer a portion of profit to DRR, make an investment, DRR investment to bank, and any interest if earned on the investment, book the interest and transfer the interest to DRR, debenture redemption reserve account. So we will pass these four entries every year until the last year of redemption. Last year of redemption, what happens? I need to redeem my debentures. So I will sell my investments, converting it back to cash. What will be the entry? Bank account debit to DRR investment account. Basically, I am selling my investments. Now, you might get some profit or loss on sale of investments. Let's say book value is 100. You might sell it at a profit or a loss. Whether you sell these investments at a profit or loss, such loss or profit should not be accounted in your P&L as profit or loss on sale of investments. Such profit or loss should be accounted in your debenture redemption reserve account. Transfer such profit or loss to your DRR account. After redemption of debentures, the balance, if any, in your DRR account will be transferred to your capital reserve. Will be transferred to your capital reserve. Now, overview, every year I will pass four entries. One, apportioning profit to DRR, making investment, DRR investment, receiving interest on investment and transferring such interest to my debenture redemption reserve account. Last year, I will sell this investment, use that money to redeem my debentures, profit or loss on sale of debentures will be adjusted in your DRR account. Profit or loss on sale of DRR investments will be adjusted in your DRR account, and any balance here will be transferred to your capital reserve. So this is about debenture redemption reserve. Now let us proceed to investment in own debentures, understanding the concept of cum interest and ex interest. Before that, let us understand whichever method you are following, when you are settling, you will close your debentures account. So you will debit, if it's 10% debenture account debit, transfer this to debenture holders account, and then debenture holders account will be debited, and credit depends on nature of redemption, bank or conversion or installments, amount will vary. This is the basic common entry for redemption. Now let us proceed to understanding investment in own debentures and concept of cum interest and ex interest. In the previous section, we have understood the mechanism of how DRR works. Now let us see the concept of own debentures. Now, assume a company's balance sheet where the company has 10% 1 lakh debentures at rupees 100 each. As a liability, company has borrowed totally 1 crore. All these debentures are listed with the stock exchange, so you can buy and sell them. So what the company has done, X Limited, in the open market, let's say Mr. Y has some debentures of X Limited. I am buying debentures of my own company. X Limited is buying from Mr. Y debentures of X Limited. So I am purchasing my own debentures. Own debentures from Mr. Y. Now, X Limited, I am X Limited, I have my own debentures with me. So what do? I have already paid him money for that. So there is cash outflow. By paying him cash, I have received an asset. What asset? My own debenture. Let's say I have purchased 10,000 own debentures. Out of total 1 lakh which are issued, I am purchasing 10,000 of my own debentures which are 10% debentures. By paying him cash, I received an asset. Corresponding to this asset, the liability also is in my books. It is my own debentures. Can I cancel both? You are allowed to cancel, but the company chooses to continue to have this in my books of accounts. So company will have 1 lakh liability, 1 lakh debentures, out of which 10,000 they have already purchased it. So when they pay interest for these 1 lakh debentures, technically they will be paying only interest for 90,000 debentures. 10,000 debentures are in your own books. So it is like taking money from one pocket and keeping it in another pocket. There are two options: pass entry only for 90,000 or pass entry for 1 lakh. What they will do is, they will pass entry for 1 lakh. We have to pass entry for entire 1 lakh. So, you will pass one set of entries for interest payment. Interest payment for entire 1 lakh debentures. However, this is like my investment. So, treat this like a separate investment. If any company pays interest on debentures, you will receive interest. I will receive interest. I will be receiving interest. So, interest will be paid for 1 lakh debentures. I will receive inflow of interest for 10,000. Account this payment separately and account this receipt of interest separately. So, we will treat our own debentures as another investment in our books and account interest inflow for this. End of the period, after when it is time for redemption, we will cancel this with this and the balance amount will be paid to the debenture holders. This is the concept of own debentures. Now let us proceed to understand what is cum interest and ex interest. In the previous section, we understood the concept of own debentures. Now let us take this example to understand the concept of cum interest and ex interest. Let's say there is a company which is paying interest 2 times a year. Once on 30th September, April, 1st April is the beginning of the year and 31st March is the end of the year. So they will also pay interest on 31st March and 30th September of every year. Now, these debentures are purchased by multiple people in the open market. So let us say on 1st of April, Mr. X purchased 10,000 debentures at rupees 100 and he has paid 1 lakh for this. Beginning of the year. Now he is expecting interest on 30th of September for a period of 6 months. How much will be the interest? Let us say it is 10%. 1 lakh into 10% into 6 by 12 will be 5,000 will be the amount of interest for 6 months. But what he has done, after 5 months, on 31st of August, he has decided to sell this to Mr. Y. Selling his debentures to Mr. Y. Now, how much will he sell these 10,000 debentures for? Now, look at this. On 30th of September, company will pay interest to X or Y. Can X go and fight with the company saying, I had the debentures for 5 months. Y had debentures only for 1 month. So pay me the interest for 5 months. Pay interest to Y for 1 month. Not possible. Company will pay entire interest to Y because he is the debenture holder on 30th of September. But why was the debenture holder only for 1 month? But he is getting interest for 6 months. He is also being benefited. Who's at loss? X is losing out interest for 5 months. So what he will do, when he is selling these debentures to Y, he will also add some premium amount. So let's say 1 lakh 10,000 into 100, 1 lakh worth of debentures, he is selling to Y for 1 lakh 20,000. So what is the gain of X? Can I say 20,000 is my gain? 1 lakh 20,000 minus 1 lakh 20,000 will be your gain? Absolutely not. What you have to do is split this gain into how much amount is attributable towards interest and how much amount is attributable towards gain. Compute the 5 months interest. 1 lakh into 10 percentage into 5 by 12. 4167. So 4167 is the amount of interest he should be getting for 5 months. Instead of getting it from the company, I am getting it from Y. So out of 20,000, 4167 will be amount of interest and balance amount will be income 40%. So the entry will be bank account debit 1,20,000. He is selling his investments. So to investment 1 lakh, to interest income 4167 and balance will be your profit and loss. We go to your P&L as your gain on sale of investments. 15,833. So out of this, break your gain into what is interest and what is actual gain. Whenever somebody sells an investment, in the question if they mention cum interest, it means he is selling his investment along with the interest gain. So you have to compute interest. Now Y is buying this from X for how much? 1,20,000. What will be his cost? His cost is not 1,20,000. His cost will only be 1,20,000 minus 4167 because he is paying 5 months interest to whom? To X. So 1,20,000 for Y includes 4167 to the extent attributable towards interest. So when he is purchasing an investment at cum interest value, out of total cost of 1,20,000, you will not debit investment to bank 1,20,000. You will only debit investment to the extent of 1,20,000 minus interest. Balance will be cost to Y and this will be your interest expense. He is basically paying interest to X. So this is the concept of cum interest. X interest means what? The sale or purchase is excluding interest. So the entire amount can be, if the sale of 1,20,000 is given as X interest, then no need to split this. Entire 20,000 will be your gain on sale of investment. Interest has to be computed additionally. So this is the concept of cum interest and X interest. So this is about redemption of debentures. Thank you.